VINCO Ventures has been a hot topic recently, and in this video, we're going to look at its price actions, the recent developments, the technicals, and my opinion on if you should be buying the stock. As the market is still very volatile for the moment, we should be mindful about which positions we pick, as well as their individual timing and exposure. Before this video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. VINCO Ventures was at some point in the conversations of a very large amount of traders in late 2021, as there were large hopes for a significant short squeeze to occur in the stock market, as well as the promises of a social media to be developed in India, one of the world's biggest markets. That desire has been partially granted in the following month, as the stock did initially go to higher levels, before gradually selling off as the interest of the stock slowly went away. In terms of timing, the fact that the volume decreased at the same time the tech stocks went through a massive correction didn't help. Nevertheless, there continues to be shareholders keeping their faith in VINCO Ventures. From a fundamental perspective, I believe that we can definitely say that the stock has maintained a certain appeal in the long term thanks to social media application. On the other hand, if the expectation is to benefit from a short squeeze, then that train might have already left some time ago in terms of the price action. And speaking of which, from a price action perspective, there is an argument supporting the entry in VINCO Ventures equity now, given that the additional downside compared to the upside is very low. Now, let's take a look at the technicals as well. The trading volume of VINCO Ventures has recently been 8 million shares versus an average volume of 15 million shares. Over the previous 52-week period, its price fluctuated between $1.04 and $12.49. The trading volume is a metric telling you how many shares are being exchanging hands and whether there is a lot of activities and attention on the stock. It often gives you a first-hand idea about the popularity of a company. When we use it to compare it with the average volume, this could also tell us if the company is enjoying additional momentum to reverse its trend or to break through current resistance levels. Even when the current volume is lower than the average, it is an interesting indication because it may signify that a trend reversal may happen soon. The market cap of VINCO Ventures is currently around $247 million versus an enterprise value of $232 million. To put simply, the market cap is the fair market value of the company based on the current market sentiment, the company's reputation, and other macroeconomic factors, whereas the enterprise value is usually the cost the company has already paid for its assets after paying off the debts. It's worth mentioning that one of the most significant assets for a lot of growth companies might be the intangibles, meaning they're not items or stocks that a company could use to generate income, but secondary items to provide growth potentials in the future. For startups, most of their valuations are based on the intangibles, which might have been valued in more favorable market terms. What this really means is that there could be cases where there can be a huge difference between the market cap and the enterprise value, giving a false impression to the market participants that a company is trading at a discount. It's only trading below the book value, but it doesn't mean that a company itself is necessarily undervalued. It's also possible that a company itself was overvalued in the first place and that it has deflated itself back to where it's supposed to be ever since. As we compare the current price to the historical price fluctuations, the stock is 2% higher than the 1-month low, 2% higher than the 3-month low, and 2% higher than the 52-week low. For the options, it seems that the implied volatility is 171% versus a historical volatility of 122%. Put-call volume ratio is currently around 0.09. It is normal for most stocks to also tend to have a higher put option volume than what they deserve because many institutional investors hedge their long positions by buying put options. The most recent volume of options traded has been 20,000 contracts a day versus the 30-day average volume of 39,000. In terms of open interest, the most recent volume of open interest has been 770 million contracts versus a 30-day average of 910,000 contracts. The option contract is a derivative from the underlying security, giving participants the possibility to have a right to either buy or sell the security at a predetermined strike price, buying the contract giving you the right, and selling the contract giving you the premiums, with the obligation to execute those rights if the counterparty chooses to do so. It is often said that you can evaluate the likelihood of a scenario based on the opposite of what the current ratio is. If there are a lot of put options, there might be a possible uptrend on the move, or that the reversal could happen soon if there are a lot of call options. The reasoning behind the theory is very simple, as most option contracts expire worthless. In terms of its shareholder structure, institutional shareholders own 10.5% of the outstanding shares. The biggest shareholders include Bluefin Capital, Vanguard, and Citadel Advisors. It is relevant to understand the shareholder composition of a company, as this helps to determine if you should hold the stock long-term or to view it as a trade opportunity. If the stock is mainly held by retail traders, this can be a sign that the stock lacks the depth to justify long-term trust from shareholders. Typically, the consensus is that there should be between 25 to 30% of institutional participation for the stock to be perceived as an investment and not just a trade. There's obviously a lot of exceptions to this, as many great titles are also mostly held by retail traders, but that tends to be the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes when there are significant short interest in the total volume, that could be a sign that a short operation has been going on. The current short interest is 21% of the total float, so this is significant for any stock, but for BBIG, in my opinion, that is not enough to trigger a significant short squeeze expectation. 49% of those transactions are also coming out of the dark pools. So usually if the short interest is above 15%, with a significant chunk of it coming out of the dark pools, this could suggest that there are institutional positions taken to short the stock. Of course, for BBIG, I don't think that this will matter significantly for its price action anymore. My recommendation for VINCO Ventures overall is to maintain a small position and to increase the exposure when the risk appetite of capital comes back to where it was a year or 2 years ago. In the meantime, as long as the existing position doesn't cause significant issues to the overall profitability of the portfolio, I think that the best option would be to hold it for at least another 8 to 12 months. I would recommend to commit between 1 to 3% of your portfolio, and would also recommend to split the allocation batches of 5 to 10% at a time, so that you could benefit from further retracements. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect the investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks with the expectation that they will be loaned to businesses. Normally, that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.